Western economists and think tanks have been predicting the demise of China's economy for a long time. The economy here was supposed to have blown up a long time ago. And it's on the issue of deflation, falling prices, that commonly trips them up. Deflation is a real thing here. The prices for almost everything are gradually falling over time. To Western economists, that is a serious problem. And that's because in the West, debt levels are a lot higher. And so in the West, deflation is a serious problem. Falling prices means lower profits or even losses. And losses mean that debts cannot be repaid. And the value of the equity, stock prices, lose their premiums and they fall. Since the debt is more difficult to repay, banks are more reluctant to lend. And they have to write off bad debts, which means the banks themselves fail. Inflation, the gradual erosion of the value of the currency, means that loans taken out today become easier to pay back over time. Deflation is the opposite. Entire industries become unstable, and recessions and even economic depressions follow, and governments race around trying to bail out banks that are going under. So when those same observers watch the chronic, persistent deflation in China, they expect the same inevitable outcomes. But it is a different world here. Chinese-style deflation is a result of everything supply chain, the access to the raw materials on a global scale, world-class infrastructure and logistics, affordable electricity also falling in price, a labor pool that's increasingly better educated at far lower costs than in other countries. These are supply-side factors that are driving costs lower, relentlessly. Investments in strategic sectors have driven massive gains in efficiency and scale. As a result, consumer prices are falling also. Household goods are less expensive as Chinese factories are building just more of them, better and at lower costs. He concludes there that this deflation is a byproduct of industrial success, not economic failure.